Thank you. Good afternoon, everyone, and a warm welcome to all of you participating in this Q3 and 9-month FY18 earnings call for Triveni Turbine Ltd. We have with us today on the call Mr. Dhruv Soni, the Chairman and Managing Director, along with other members of the senior management team. Before we begin, I would like to mention that some statements made in today's discussions may be forward-looking in nature, and a statement to this effect has been included in the invite which has been emailed to you earlier. I would also like to emphasize, while this call is open to all invitees, it may not be broadcast or reproduced in any form or manner. We will start this call with opening remarks from the management, following which we will have an interactive Q&A session. I now invite Mr. Dhruv Soni to share some perspective with you with regard to the operations and outlook for the business. Over to you, sir.
Thank you, Kevin. Good afternoon, everybody, to the 9-month FY18 investor call. I'm going to take a little longer than normal to brief you on the operations, how the situation is today, and our thoughts of the future. Net income from operations was at 5.07 billion, and the lower turnover is really on account of rescheduling of deliveries by customers and the development in the execution of certain development orders. Actually, this has happened both in the domestic and international markets. When I come to Q4 and going down, there is corrections that are coming on fairly quickly. But the situation as of today, the PAT is at 606 million. The strong point is that we've had a strong order intake during the quarter and the 9 months. And we have a 9-month order growth of about 9%. But the best point is that our export order booking has increased by 33%. There hasn't been much movement in the domestic market, and as I'll come to later, this is what is reflected in the 6-month accounts, 9-month accounts. But the export order booking growth, which was not there in the previous year, 16-17, has changed. And now with a strong outstanding order book of just under 7 billion, 6.97 billion, it's about 10% higher than what we started off with at the beginning of the year. And the decline in margins is primarily due to the product mix, both in the product and aftermarket. The order booking last year was down on exports, and there where the margins are much higher. These are what are being executed this year. This situation will correct itself because of the substantial increase in export order booking in the first 9 months and what we contemplate also for the balance of the year. There is also the adoption of hedge accounting in the current financial year, as a result of which hedging gains and losses, which have been considered in other comprehensive income against other income or expenses reported in the previous period. And so sort of an MTM gain of about 6 crores is going to be reflected when it is realized. During the 9 months under review, domestic sales are significantly higher because of the order booking position last year at 14%, and exports are lower by 28%, and this has had an impact on the overall margins. In the aftermarket segment, revenue from refurbishment has been lower than our estimation. This has taken longer, especially on the export market side, to pick up. But we are seeing very good inquiries, and certain things are under finalization now. But that's the scenario for the performance, consolidated performance up to now. On the market, the domestic market continues to remain muted. I'd love to have given a more brighter picture, but I cannot see that. In fact, there's a decline of about 10%, with even though new inquiries generation are more or less at the same level of 1.2 gigawatts. But the market has gone down. People are taking much longer to decide. The brownfield, new field projects in the process areas, as you all know, are not happening in the way that we had thought it. So we are really, again, now focusing on the export and the aftermarket for the next 6 to 9 months in terms of order booking and executions, and putting renewed efforts there. While new inquiry generation in the international market has not improved, not gone up, because you know that in the power market in general, there has been a very big problem with the big majors. You've been reading in the power lines, the big groups, GE and Siemens have had substantial problems in that. But in our line of under 100 megawatts, especially under 30 megawatts, the inquiry generation hasn't gone down, and neither has the market gone down. But the good fact that we are seeing now is that we are having an improved new inquiries coming in from certain parts of Europe and Central and South America. And where we've seen results in the last 9 months is in the parts of Southeast Asia. Very good results in Thailand and South Korea in the process cogeneration and the waste to energy. These were better than expected, and are expected to go forward. These are countries, and Vietnam, which we are expecting to carry on with their growth and concentration in renewables, in the biomass and waste to energy and process cogeneration areas. On the product booking side in the international market, which is gaining momentum, there's the domestic market in 9 months has shown a decline of 24%, while in the international market we've had a growth of 55%. That's 2.7 billion exports versus 1.7, and domestic 1.6 billion versus 2.1 last year. The domestic market being constrained has had an effect on competition. We haven't lost market share, but there is an impact on prices and margins. Fortunately, this is not prevalent. There is some pressure, but there's a very slight pressure in the international market. But on the international scenario, there isn't more competition. In fact, some of the from the older players are less now from South America. But because the market has been dragging and taking longer in 16-17 and parts of 17-18, there has been competition. But we see a much brighter picture as shown by our order bookings internationally going forward as well. In the aftermarket segment, which has the margin growth in order booking, the growth 2% on order booking, and on the turnover a growth of 6.5%. And the aftermarket sales to total sales has risen from 23 to 28%. Spares have shown a good growth. As I said, refurbishment hasn't met our estimation. Services are flat, but both these areas are expected to take effect a little in Q4 and next year. The export offices that we've set up they've taken longer to have converted inquiries into orders. And this is something that you just have to play with. We are correct in our decision of where we've gone. As I said, Thailand's gone up, so we are happy that we have an office there. South Korea, we are handling from Thailand. Vietnam, we are handling from our office in Indonesia. South Africa, we have an office, and MENA, we also have one. So we are in the right places, and we do feel that these are going to turn out the way we had thought so when we put them up. In the 9 months under review, exports, as I mentioned, have had a healthy order growth of 33%, and this has helped the overall order booking. And while the spread at the moment is from Southeast Asia and Europe, if you ask me, the new places where I'm looking for is Central and South America, which has taken longer, but it's getting a lot more traction now. And we are very well positioned there versus competition. And our pricing is good as well. The mix of exports to total sales has come down from 56 to 44. And this is, as I mentioned earlier, an account of the lower order booking in FY17. The mix of exports in the current year's order booking is now 54% from 45% in the previous 9 months. So this 9% growth we expect to continue, and we expect this is a sort of where we are seeing FY19 as a much better, even though the volumes are going to be about the same growth rates, but the mix is going to be much better, and the surety of conversions are going to be also better. And we are not having to rely on the turnaround in the domestic market, which till it happens, I would not like to put into the budget. Coming to GE Triveni, the turnover has been in line with the orders on hand, and the results for the quarter are reflective of the fact that there's been no dispatch, and we've had to bear the overheads. But there are a couple of orders that are almost where they are really in the finalization stage. We're waiting for advances, etc. in Q4. So what we were expecting during the year has taken longer, but some we expect to complete before the financial year FY18. The strong focus that the company has on technical development is continuing. And in fact, we are increasing our spend, and we are increasing our market share in the ranges where we are not prevalent. We are having new product developments in the oil and gas sector. We are having new product developments under 30 megawatt for process cogeneration. We have a new generation of blades, profiles, and our modular program, which was under development, is now complete. The IPR of the company has been building up very well, and it has continued. And we are filing a number of new IPRs in the overseas territories as well, which is something that's going to carry us forward and as a hedge to the vagaries of one particular market and one particular product range. Domestically, I would say that while the sugar, food processing, and process cogeneration are very potential order givers, when they are going to come about is not clear. The movement in steel is good. Again, it's a little bit short to medium. Cement we are not sure of. Waste to energy is taking longer, but it is a segment that has to come. We believe that order finalization in FY19 domestically will improve, starting from the first quarter and possibly definitely the second quarter. International pipeline I've already covered, but I'd like to say one thing, that in the international market, in the renewable space, there is increased emphasis, not just on biomass, but particularly on waste to energy, and from a number of developing nations. In fact, they're going ahead much faster than our domestic market, and that augurs very well for our product range. In the sugar sector also internationally, there is better traction than we had expected, especially from Central and South America. Refurbishment is showing good visibility, and as parts of South Africa, the South African development region, while they're not placing orders for new equipment, they're looking very strongly at refurbishing and older equipment. So a number of countries where they are not going in for new projects are now getting about thinking of refurbishing their old turbines. And here we have very good chances. This, of course, as you are aware, is the refurbishment of other people's turbines. So it's a whole new line with a good margin. Based on the scheduled deliveries for Q4, we believe that much of the backlog in deliveries will get addressed. And overall, we expect a similar or marginally higher turnover for the full year. With a strong 9-month order book, and turnover and profitability is expected to improve quite a bit in the coming quarter. And with the increased export and aftermarket operations and a strong order book in the inquiry pipeline, we think that the performance this year for the company is going to be good, even though slightly below our expectations. Thank you.
So do we take questions now?
Please.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, sir. I had a question.
Yes, please.
First on the execution mix that we had, what was the quantum of execution that could have been done extra incrementally this quarter but is getting postponed? Is it domestic or exports, and can it be recouped in the fourth quarter?
Yeah, I mentioned that a bit. Actually, it's both. And quite a bit of it is scheduled to be recouped in the fourth quarter. A little bit has been done already because we are halfway through. But we are expecting quite a bit of it to be done in the fourth quarter. What slips, of course, will go to early part of Q1. But we are targeting quite a lot of it to be captured. That's why I can say that we're expecting the year's operation to be similar or marginally higher than last year.
And this challenge was related to export orders or?
Both.
Both, huh?
Both. They're a little bit of both.
Got it. And approximate quantum, what could have been there?
I don't want to give the quantum, but one of the things we do is that we don't dispatch without payment. We are not relaxing our commercial terms. I think, one of the things that Triveni has managed is that we don't have all this debtors and those problems. So I would rather take the impact on turnover and tell you what it is, quite frankly, rather than compromise and have the dispatch and book the sales and the profit and then have it as a due. So we have not changed our commercial terms either internationally or on domestically. You see, internationally, it's we have FOB supplies, to give you an answer, and sometimes they just take 6 weeks to send the ship. So you're just left with and these are not commercial things that you can really go on an escalation or something because you want to preserve the relationships. So I would say that we will continue with our commercial policy. Given that commercial policy, I'm still expecting most of it to be recaptured. But that's the long and short of it.
Got it. And sir, internationally, the demand scenario from or rather the economic activity in US, Europe, etc., has started seeing an improvement. And the commodity prices are
Excuse me, this is the operator. Mr. Swaminathan, can you speak closer to the phone, please?
Yeah, am I audible
Yeah, this
now?
is better. Thank you.
Yeah. So, and oil prices also are going up. So, do you see traction improving from key markets, especially Middle East? You used to talk about large or sizable orders.
Good question, and gives me a chance. In the Middle East, we've taken. It takes time to get registered with various agencies, and that has progressed well. So we expect a good inquiry intake, and that has improved. By the way, you're quite right. That activity is coming up, and so we are concentrating on the Middle East, and with the dispatch of our order on KNO, Kuwait National Petroleum Company, which is one of the delayed ones from the customer side. Actually, they're not going to commission it. They're 9 months back on their own project, which is one of these things you can't do anything about. But it's a big thing for us, and it's still on track. And the U.S. we are up to now, we have not approached the U.S. market, but we are seriously exploring the market now that we have a good office in London, and looking at servicing it much better from there.
Got it. And with respect to the domestic market, what would be the size of the market? Earlier calls you had mentioned that 0 to 30 megawatt would be somewhere around 400 to 500 megawatts.
I had that figure here somewhere. 387.
380.
We put it. This is versus 430. We are saying 390. So it's about 8-10% lower. There's no big thing there.
Okay, and in terms of steel, you have mentioned some improvement which is there. Is it with respect to the larger players or mid-level?
Yeah. But this is very preliminary inquiry levels, So this is not even budgetary. So I don't want to put that as anything in a target till I start getting more traction in terms of serious discussion. So that's why I'm not putting the domestic market as anything where we are concentrating in the short term. We are having to renew our efforts export-wise.
And
so that is an upside when it comes. That's an upside when it comes, but it's not something that we are saying right now.
Got it. And after sales, it has grown at single digit. You told that there is some issues with respect to refurbishments. Next 1 to 2 years, do you see it coming back? Because we have been spending so much in terms of setting up offices.
Yeah. Good point. We are seeing a very strong improvement in FY19 in refurbishment. That is the latest feedback I took about 2-3 weeks ago for our 18-19 budget globally. We are seeing a very strong committed order booking.
But refurbishments would be what percentage of aftermarket sales? Any rough figure?
That's a very, you see, there's a lot of refurbishment is done by local players, and that's a very small refurbishment. Our refurbishment is getting the rotor back to Bangalore. So we are competing in a different space. People who have to do small little refurbishments, we can't do that because you need a workshop there. And that's got a lot of overhead for the type of market size. So we, for what we quote on, seriously, we are very, very strong hit rate.
Got it. And lastly, if you can give the status of the new facility and also the GETL's 9-month numbers. You told execution was not there in this quarter, but 9 months number, both revenue and our share. If you can tell that, it would be great.
I think Ravi, it has been provided in the investor brief. We have around 93 crores of turnover and around 1.6 crores or something is a profit.
Okay, but that will be for the JV level. Our share would be by 2, right? On that one.
50%. Yeah, exactly.
Yeah, and the status of the facility, sir?
Yeah, the facility is extremely good. We've had a lot of visits by international customers from the combined cycle line and the oil and gas line. We now moved all the larger turbines there. The very high-speed balancing is going to be in operation this month. So it's all complete, and the production is going off. The GETL large turbine, especially the 80 megawatt one to Argentina, was shipped from there. So, there's not much cost left so there's no capex much coming in, and not expected for 18-19 as well. There's almost no capex. And it's been all internally funded, so we have got not much fixed overhead. The productivity is better now in the last quarter than what we expected, and actually better than our old facility. So it is a good decision. I would say that we have the capacity to almost double turnover.
Double turnover. So capacity utilization is roughly around 50% at a company level.
Yeah. But, that's it's low cost, so, it's really a question of, you can't say capacity. We have got the capacity now to take on a larger range of products, a more sophisticated products in our testing and in our assembly, so we can cater to a higher range also.
Got it. Thanks a lot, sir. Thanks.
Thank you.
Thank you. The next question is from the line of Manish Kowal from Enam Holdings. Please go ahead.
Yeah, thanks a lot and very good afternoon, sir. Just to get a perspective on near-term growth, sir, we mentioned that both domestic and international pipeline has been more or less similar, and if I look for first 9 months, the order inflow has been single digit. So, sir, just to get a perspective on FY19 as to would it be possible to register a double-digit growth in such a subdued scenario, sir, with subdued inflows and the inquiry pipeline to be quite weak?
I'll tell you, it's difficult to give a call, but I'll tell you where the encouraging factors are, because we are almost at double digit. It's in the international market and on our new, in our new territories that are opening up. We've been there, but they are opening up now for the inquiries becoming more serious. Central South America, and the encouraging things we've had in Southeast Asia, Thailand, Korea. So I would say if the domestic market even slightly picks up, definitely we'll get double digit, Okay. Without the domestic market picking up, we will be having to compensate for hardly any growth there.
Sure.
So you are having to then get much higher growth in the export market,
right.
And now we've got a higher base also.
Yes, sir, but already like in current year, the domestic inflows have been quite subdued. So agreed that exports will do well probably next year based on the inflows, but domestic order inflow is quite weak on one side, and on second side even aftermarket seems to be just 2% on a 9-monthly basis. Inflows have been higher. So a bit concerned on the growth aspect for next year. That was one. And second, on the margins as well, sir. In first 9 months, the margins have been almost 360 bips lower than last year. And so how do we see that going forward as well? Because now steel prices are going up and a lot of material costs are going up.
Yeah. So let me give you, I mentioned that in the opening remarks, but I'll repeat it again. We have a much better margin forecast because of the order booking position today, which is more export than domestic, which it wasn't at the same time last year in the order booking. So that's why the dispatches that you've seen in the current 9 months are much more in the domestic market than on the export market, and that has the effect on margins. But the positive part for the future is the order on hand of export, and going forward again is the growth in that, and we don't find any slowdown generally in the global economies. There was something 2 years ago which affected exports in FY17, but we don't find that now, and Europe and Asia is quite gung-ho, so is Central America. Secondly, the position on aftermarket, domestic aftermarket, if there's not much growth in the market, there's not much growth in the aftermarket. But we see good growth in the export aftermarket. So when I'm talking about refurbishment growth, I'm talking about services growth. It will mainly come from the export market.
Okay. So
which is good because it's surer and it's at a good margin.
So at least in the coming times on profitability side, we will see much better growth than the top line, right, sir?
We expect to see a much better, definitely because of the change in mix and the various sectors that we are in.
Okay, sir. Thank you so much, sir. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Anuj Saigal from Manas Capital. Please go ahead.
Yeah, hi, Mr. Sani. I just wanted to ask about the JV with GE. As you mentioned, the troubles that GE is going through, especially in their power division, there is some discussion that they might be retrenching from some of the markets. So could you share some thoughts as to whether the small turbine market is a focus for them, and what is your sense of whether how do you see the JV continuing from here on?
I'm glad you asked that, because perhaps I should have clarified that GE, when it had the merger with Baker Hughes, formed a company called Baker Hughes GE, in which it has 60% holding. And our joint venture now and the lower turbine line of industrial turbine, which is under 130 megawatts, has been transferred from GE Power to BHGE. Now, BHGE is primarily in the industrial and oil and gas area, and this area actually is doing better. So we are not dealing with GE Power or with GE. We are dealing with BHGE, and the official collaboration is also with BHGE, and that market is okay. And where we may have a thing is in the combined cycle supplies of the power market, but that's same to all the competitors, whether it's GE or it's Mitsubishi or Siemens. And I already covered that. But that was not a large part of GE Triveni. It was catering to the sugar industry, the process industry, the steel industry. Some part was the oil and gas industry, fertilizer in Indonesia, in Argentina. So the problems of the power sector generally, it does not affect us. What it has done in one or two cases is delaying some deliveries, which were to the combined cycle, which we already had. So, in fact, that's, now that you've asked it, that is one of the answers.
Yeah, and I just had a follow-up question. So now that you are dealing with the JV, the Baker Hughes GE JV, there is also discussion that GE might be looking to sell the Baker Hughes business. So what happens in that scenario?
But the technology is all with BHGE, is not with GE. The Alstom technology, the GNP technology, the GE technology is not with GE in this line of 130 megawatt. It's with BHGE.
Okay, thank you.
So actually, it's the GE Power is in the higher line, above the line of industrial. It's more in utility and gas.
Right.
It's an important question, and I'm glad you asked it.
No, but I think my question was, Mr. Soni, that if GE were to sell Baker Hughes, then does that revert back to GE?
It has no effect on us. Our agreements are still valid. Whoever buys it. The technology is still there.
Right.
The need of GE in our JV is not there. The need is only of BHGE, which already has it.
Okay.
So the operating point is, and what you're asking is similar to what some customers ask. There is no difference in the either getting orders or executing orders or servicing orders or the growth of the business. Okay?
Okay, thank you.
Thank you.
Thank you. The next question is from the line of Charanjit Singh from BNK Securities. Please go ahead.
Hello?
Charanjit Singh, your line is unmuted. You may go ahead with your question, please.
I think
As there's no response from the current participant, we move to the next question from the line of Ashi Anand from Allegro Capital Advisors. Please go ahead.
Yes, hi. Thanks for taking my question. The first question is, with relation to margins, I just want to understand, do we have raw material pass-through clauses in our contracts, or do we typically hedge kind of key raw materials? Just want to understand how we protect against rising raw material prices.
Yeah, it's a good question. We have long-term rate contracts because we are buyers of specialized raw materials. You know, our turbine rotors and all are specialized, and casting. So it's not really the commodity steel, or other raw materials. So we have these long-term contracts. And secondly, when we get our orders from customers, or when we are quoting, we make back-to-back arrangements with our suppliers, fixed price arrangements with them for those orders.
So
for the raw material for those orders, before we take the order on.
Okay, excellent. So we are fairly insulated in terms of when we get an order, we do.
Perfectly. There's I would say, no exposure there.
Okay, great. The second question is, you mentioned earlier that our margins in exports are actually higher than domestic. However, if I just look at the 9-month numbers and if I look at how margins have moved, domestic revenues are higher than exports. We've actually seen a gross margin expansion, and the margin declines actually come in terms of employee costs or SG&A expenses. I just wanted to understand if you could just explain the gross margin expansion in a period where domestic revenues have actually grown as a share.
Yeah, that's a good point. Actually, I want coming to the gross margin anyway. One of the good things is that whatever you look at, the gross margins, we have managed to preserve our gross margins. Now, sometimes you book certain costs in one quarter rather than another quarter. These are to do with offices or to do with certain site expenses. So I would really take it over the 9-month period rather than a 3-month period. But the important point to mention is that with all this competition and with this change in product mix, our gross contribution, even versus last year, is pretty good. And I would, we book the expenses as we incur them. So sometimes you have some extra expenses one quarter at site. Sometimes you have much less at site. It's a capital good, so it's very difficult when the order is a 12-month cycle to know exactly what is going to happen every month. So I would ask you to look at the 9-month figures on the same question rather than the 3-month figure.
Sure. So the only thing is, even if I look at the 9-month figure, the same kind of the same kind of observation holds. Gross margins from a 9-month basis have expanded in a kind of period where domestic kind of the domestic revenues have gained share.
Yes, this is because there has been some extra expenses on our overseas operations, and that's one of the reasons for it.
You know, if exports were at the same level as last period, then you would have actually seen the margins would have gone up by at least 2% more.
Okay, excellent. So the mix of the margins will be different. It may not come through necessarily at the gross margin level. Would that be fair?
Yeah.
Okay, excellent. Great. Thanks for all the answers.
Thank you.
Thank you. Reminder to all the participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. The next question is from the line of Pavan Kumar from Unifi Capital. Please go ahead.
Sir, my first question would be, what is the current order book outstanding on our JV side, GETL side?
It's around 134 crores.
1.24 billion, right?
1.34.
Okay.
Yeah.
And of this, how much of this order book would be already included in the 6.96 billion order book that is that Triveni consolidated already carries?
It's close to 50%.
50%. Okay. So effectively, our order book, if I'm right, comes to around 7.7 billion.
Right. Yeah, but we don't have that in the...
it is not consolidate the order book.
Because you don't consolidate the order book, neither do you consolidate the sales of the JV.
Fine, sir. My question was actually very simple. In the sense, see, last time in 2017, it was our peak year where we did 770 crores of revenues and around 123 crores of PAT. My question is simple, in the sense if we wanted to go beyond 800 crores, our order book has to go somewhere, at least on the consolidated level, 6.96 billion has to go somewhere around 800 crores. And on the present rate of order book growth, that seems very, very unlikely. So,
no.
What are we going to? So, what is your outlook?
I'll tell you. You see, we had a substantial. If you look at the book and bill in the year 17-18, the current year, what orders we booked in Q1 and Q2, and which we are going to execute this year, they are 160, so I would say 1.6 billion. And that's only for product. For the aftermarket, it's even more, because that has a 6-month cycle or 8-month cycle. So there's quite a lot of book and bill.
Okay, fine.
So it's not if it was a situation of looking at the current order book and that's going to give you the turnover for the year, then your point is right. But you have to forecast a certain amount of book and bill. Now, if I forecast the same book and bill as I got this year, then it's extraordinary. But I can't be sure of that. Because even if I book the orders, which are going to be, some part of it may not get billed. But from 1.6 billion, you don't expect it to go down to nothing. You know, there will still be a substantial book and bill as we've had for the last 4 years.
So, book and bill, what would be at least the rough estimate of what it generally turns out to be?
That's $1 million question, because you don't know the customer and you don't know how they. But you can roughly say that I'm giving you the figures of actually what happened this year. You want to take all of it? You want to take 75% of it? We know the potential order booking next year, which is very good. How much of that, when the customer, which month he'll do it, if he does it, and if he takes a little longer to give us the advance, then we don't start executing it. So it's difficult to actually pinpoint the book and bill. But I would say that the main answer to your question is that the orders on hand is not reflective of the growth of turnover.
Okay. And secondly, on the JV side, again my question is, we have not seen any new orders being booked in the last 2 particular quarters. This has also been mentioned in your notes. So when are we going to see some significant traction on that side? And what are the problems we are facing so that we are aware?
As I said in my opening remarks, we've actually, I would say 95% closed, but we don't close an order till we get the advance. But we expect traction in Q4.
Okay,
before March.
But can we assume that the growth on a base of 120 crores is going to be very significant? Maybe this JV has a capability to maybe go 2 or 3 times and maybe, let's give a timeline of some 3 years. But does that potential actually exist?
No, if you look at where the markets are going, the JV's market share is still got a lot of space for expansion. Our contracts are just being executed and commissioned. Okay. And the international market is improving. So certainly in the next 2 years, I do expect, we had very good order booking 2 years ago. So there's no reason why you can't have that same sort of thing coming again any year. And that is a huge increase. You go to 80-90% increase over what you've done. Okay. Just a few orders add a huge amount to the turnover and order booking of the JV. So I would say definitely why 3-4 years. In 2-3 years, we expect definite difference in the position of orders on hand and turnover.
And on the JV profitability front, sir, I understand that there has been a slight decline on the revenue booking on the JV side, but the profitability seems to have come down significantly. We did some, if I'm right, 4.3 crores last year.
Yeah, I agree.
In 9 months as compared to some 50 lakhs this year. So what are the kind of challenges we are facing on the execution front?
Well, it is a delay in dispatches. Mm-hmm. So the turnover is not there. So, with our index accounting, it's all at cost. So you have nothing coming in till you dispatch. And export dispatches are actually when they go on the ship. So, and these are large turbines. So, going from one quarter to another quarter, 2 quarters ago, you have it, and you suddenly have a big bump in profitability. So that is really it's a reason of execution of the orders, not a question of the margins on the orders.
Okay. And my final question, sir, actually for this year, we have still held in our note saying we might do revenues on par with 2017 or maybe slightly grow. And 2018 during the Q4. Do we? I mean, it looks very challenging given your performance. We are around 12% down on the revenue side. So, what are your comments on that, sir?
My comments are, I wouldn't have put it down if I didn't think.
I know execution has to be much faster, but do we have
No, it's a good question. Let me say execution is not the problem. I'm 200% clear that we have the capabilities, all the material is there. If anything, there may be, if there is, it will be from a customer. But I don't expect that also when I made that statement. But of course, that is always a small caveat. We've taken that into account, but I can say that from an execution and having it ready, we are able to fulfill that statement.
Okay. And one last thing, if I could just fit in. 2019, would it be a realistic expectation that at least, I don't want a guidance on maybe the bottom line or whatever, but on the top line front, is it possible for us or is it realistic for us to expect some 10% growth or
I don't want to go there, but I want you to look at the order booking position.
It's 10% higher, so
yeah. So you have to look, and then I will give you the order booking position when we end the year. and then you make some estimates of book and bill in the first couple of quarters, and then that's the result.
Okay.
So basically, the movements are good.
Okay.
Now, in this capital goods business, it's not as easy to give a guidance or want to go that way. So I don't want to I'm not hedging something, but I'm laying out all the facts to you.
Fine. So overall, we expect the profitability also to come back going forward.
Yeah, absolutely. Because of the product mix and the growth in the order booking.
But it will take place after Q4, since Q4 also there might be a significant proportion of domestic orders.
No, we expect a much better margin in Q4.
Okay, fine. I'll get back in the queue. Thanks.
Thank you. The next question is from the line of Charanjit Singh from B&K Securities. Please go ahead.
Hello, sir. Thanks for the opportunity. So if you can help us understand, what is the kind of end market breakup for the first 9 months, in terms of cogen, cement, and also from export market perspective, what would be the proportion of, or which geographies will be contributing, and how much proportion in the export sales?
I can give broad geography, but I don't want to go into specifics, big market sensitive information. I'll ask my colleague to see some, if he has the breakups available with him.
Yeah, Charanjit, I think broadly the breakup for the export market, we have more than almost 40% came from the Europe, almost 30% came from the SAARC and Central Southeast Asian region, and the rest of them is spread all over across the globe. So that is broadly the mix of exports. And in terms of the segment, we have, in terms of domestic, almost 60% of the order booking came from process cogen, which comprises of paper, chemicals, then almost 20% is from sugar, and the rest of them is spread over in the other segments. And in the international market, predominantly close to 3/4 of the orders came from the renewable space. And the balance is from sugar and paper and other process cogen segments.
So this important, renewable space and waste to energy, you have, talked about in the initial remarks also. If you can, give us some more color about these two markets, like, how they're evolving internationally, which geographies we are seeing much more.
Yeah. You see, this is evolving very well because, you see, with the environmental problems of zero discharge and most places are going to looking at municipal waste as something that you can't, you have to incinerate, and so it's surprising that even some countries in Africa, more than we find the cities in India, are coming around to this. And basically, this is a sure market. The problem is waste collection. In countries like India, waste collection is a real problem. But in other places, it's not so bad. Now, you still, what's happening, which is a very good thing for us, is you're having a lot of these waste-to-energy projects where waste collection does not necessarily have to be in the very sophisticated Western fashion of every 4 things in different types of containers and everything segregated and all that. You still have very good power generation and very good waste-to-energy projects coming up and very viable. So they're fundable, but the fundability of this is there. Now you're having a lot of private equity players in, say, even in the developed markets, but even in the developing markets coming into these projects. The technology is not a problem either so it's a question of local municipalities and towns so this is something that we can only grow. And it's both in developing and developed markets.
Okay, sir. And so we have also talked about, LATAM and South American, geographies, and we have also seen, good traction in the Southeast Asian markets. Now, going forward, as still, our order book backlog doesn't give us so much comfort on a very high growth scenario. Could you see, like, some of these geographies, translating into bigger order inflows, maybe in Q4 and Q1 So which geography, holds more promise for us where you are seeing this visibility, sir?
Central South America. And possibly Europe, a little more in Europe. I don't think there's a huge growth in the Southeast Asia. It's because it's done very well. So frankly, to get a huge, I certainly will be preserving what we are getting in it on a pro rata basis. But the growths to go over this base are coming from there, and little bits from Africa. But in Africa, the problem is finalization. It takes a long time. They are not a potential, but now we don't start calculating on it the same way we thought earlier till it's much more advanced.
And the last question from my side is...
Operator. Yeah. Mr. Singh, may we request you to please rejoin the queue? There are other participants waiting in the queue, please.
Thank you.
Thank you. The next question is from the line of Darshika Khemka from Edelweiss. Please go ahead.
Yeah, hi sir. Afternoon. This is Swarnamer. Sir, I just had two questions. First one is, you did mention about, execution delays, customer-led delays and all. I just wanted to understand if it is possible for you to quantify, that delay. For example, 40-50 crores of shipments were not, you were not able to ship or something like that. That will be of great help. And secondly, sir, you have kind of, touched on the domestic waste to energy space as well, where I guess you are targeting the municipalities over there. Sir, if you can throw some light over there with respect to margins, because what we understand is normally the municipal business, normally what we perceive is, to be of a low margin and a high working capital kind of a business. So if you can throw some light over there as well. Thank you.
Okay, good. I'll take the second one first. Actually, when you talk about waste to energy projects, don't look at the municipal business from a municipal low margin, because it's a sophisticated power plant. There's not too many players who can give these turbines or give the equipment for the incineration and the biomethanation, So it's a different space, so therefore the margins are substantially better than they are in domestic process cogen, for example.
Okay.
Secondly, there are, as I said, when we are saying that we are trying to trying to make up the lost ground on the 9 months versus last year in Q4, there is a substantial amount of orders that have got not picked up, or some parts of the logistics are not working out from a customer angle. So I wouldn't like to go into the exact figures, except to reiterate that we do find from an execution point of view that all of these can get executed, and we're hopeful that where the customers were not picking up in time for the first 9 months, they'll do it now, because they are saying they're going to do it now. So that's why I'm making the statements, because it's not on a basis of best wish. It's on a certain commitment.
All right, sir. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, with this I now hand over the floor back to the management for their closing comments. Over to you, sir.
Thank you very much. Thank you for these very interesting and very good questions. I would just like to reiterate that we are happy that we have a much better platform of order booking in the first 9 months, both in terms of quantum and in terms of product mix of both exports and domestic. And also our inquiry base on aftermarket in the export area is extremely good, and we do expect growth in both Q4 and in certainly in FY19. So we expect a good push from here. The domestic market, again, we are not sure as to when the turnaround will be. We will be looking at it on a quarterly basis with you. At the moment, we do hope it's going to come in Q1, Q2. Certainly new geographies internationally are becoming much more promising than they were before. The stability of the industrial space in the developed markets such as Europe is useful. The stability of industrial space in Southeast Asia is very good. And with the oil prices now being different to what they were a year ago or 2 years ago, we expect our North Africa and MENA region to also start giving much better results. So with that, I thank you all for participating in this call and look forward to talking with you in the next quarter. Thank you.